Hello and welcome to this session on foreign exchange markets where we will cover types of FX rates. In this session you will learn about factors affecting FX rates, examples on speculation, examples on arbitrage, examples on hedging, methods of executing FX, and finally types of FX swaps. Let us begin by understanding the factors that affect the foreign exchange prices. First is demand and supply. This is a simple concept. If particular currency has a higher demand from market, then it will appreciate against the other currencies of the world and vice versa. Next is the rate of interest. The understanding is that if the interest rate in a country is high, global investors will want to invest in the country and earn a higher rate of return. This is in turn leads to a higher demand for a currency, leading to appreciation of the currency. Next is inflation rate. A country with higher inflation rate will have a lower currency value or rate, since the higher inflation will eat into the value of currency and reduce its purchasing power. Next we have political and economical stability. Countries with more stable government and spending policies attract large number of investors, and investment venues are considered to be more safer and stable, hence increasing the demand for local currency, which in turn appreciates against the other currencies of the world. Next we see is fiscal deficit. A fiscal deficit means that the government spends more than the income they earn in form of taxes. Higher the amount of deficit, higher the spending. This implies that a higher rate of inflation leads to a lower currency value. Finally, the current account deficit could impact foreign exchange prices. This is a situation in which a country is importing more goods and services versus its exporting numbers. Hence, this increases the demand for a foreign currency, which in turn depreciates the value of the local currency. Let's look at some instances of foreign exchange trading. If you remember, FX is traded for four main reasons: speculation, hedging, arbitrage, and need-based trading. Speculation. It refers to a trader taking position in market with the view that market will move in a particular direction. For example, if he speculates that market will go up, bullish view, he will buy the security with the aim to sell it at higher rate later. If he speculates that the market will go down, bearish view, he will sell the security with the aim to buy it at a lower rate later. Hedging. This refers to taking a position in the market which minimizes the losses on a particular investment. Arbitrage. This refers to simultaneous buying and selling of the same product across two different markets with a price differential. Need-based trading. This refers to trading foreign exchange in market as participant needs the currency. For example, a UK-based client wants to invest in Indian market. He will therefore enter the foreign exchange market as he needs to convert GBP into INR to fulfill his investment obligation. This contributes to approximately 5% of total market volumes. As you know, speculation, hedging, and arbitrage combined account for roughly 95% of total FX volumes that are traded. Let us look into speculation, hedging, and arbitrage in a bit more detail by using examples. Let us begin with an example on speculation, which, as you are aware, is a practice of engaging in risky financial transaction in an attempt to profit from fluctuations in the market value of tradable goods such as currencies. A trader is looking at euro to USD rates and speculates that the euro will strengthen in a month's time. He can undertake the following FX trades. For instance, he can buy 100 million euro and sell USD 138 million for 1.38 for today. Let us assume a month later he was right. The trader can now sell 97,183,000 98.60 euros and buy USD $138 million at 1.42 at a month later. That way, he makes a profit for Euro 2,816,901.40 in a month. Moving on to example of arbitrage. Arbitrage is basically buying in one market and simultaneously selling in another, profiting from a temporary difference. A trader is looking at GBP to Euro rates in US OTC market and the London OTC market and looks at certain price differentials. To make a riskless investment, the trader will have to place two orders: buy 100 million Great Britain pounds and sell 121 million euros at 1.2100 in London market, and sell 100 million Great Britain pound and buy 121 million and 50,000 euros at 1.2105 in the US market. That way he makes a profit for 50,000 euros. Let us now take an example of hedging. A hedge is an investment position intended to offset potential losses, gains that may be incurred by a companion investment. A trader is long of USD Hong Kong dollar 1 billion where the spot rate is 7.75, which is due to settle 1 year later. Based on new information from this research on trading team, he thinks the HKD or Hong Kong dollar will strengthen to 6.90 levels 1 year later. To hedge his position against the Hong Kong dollar, he can enter into below contract. After research, the trader sells USD is to Hong Kong dollar 1 billion at 7.40 for settlement 1 year later. That way he ensures that he is further insulated from strengthening of HKD. As per the hedge, he makes a loss of 0.35 Hong Kong dollar compared to 0.85 Hong Kong dollar per US dollar. There are few methods of executing foreign exchange in market. First, we have algo trading. Hereby, systems are fed with algorithm trading logic, directing a computer to buy or sell depending on market conditions. Next is CurrentX, FX Connect and FX All. These are platforms used to trade FX and are used by client side of the financial world. Next, you have platforms such as Juto Matching, EBPS and SPEED. These are used by the broker or dealers or investment banks to trade FX. Other methods include Bloomberg terminals, telephones, emails, and broker platforms provided by ICAP, Juliet, etc. The important terminologies involved in foreign exchange trading are shown on the screen. These include trade date or TD, or short is the date on which the trade is agreed to, settlement date, or SD for short, the date which is funds are exchanged. CCY1 and CCY2, these are first and second CCY respectively of the transaction. Similarly, you have notional 1 and notional 2, which is amount of CCY1 and CCY2 respectively. Next, you have exchange rate. The exchange rate is the rate of which one CCY is exchanged for another CCY. Direction refers to the CCY being brought and CCY being sold, and counterparty refers to other party in an FX transaction. The types of trades dealt in foreign exchange market include cash, spot, term, NDF, futures, forwards, and options. We will now learn about each of these types. FX cash. This is a transaction where the trade is agreed and settled on the same date, that is settlement date or SD for short is equal to the trade date or TD for short. In other words, the two parties agrees to trade on the same particular date and exchange the two currencies on the same day. FX term is a transaction where trade is agreed and but settled on the next date, that is SD is equal to TD plus 1. In other words, the two parties agree the trade on particular date and exchange the two currencies the next business day. FX spot is a transaction where the trade is agreed and is settled 2 days later, and that is SD is equal to TD plus 2. In other words, the two parties agree the trade on particular date and exchange the two currencies 2 business days later, that is T plus 2. FX forward is a transaction where the trade is agreed and is settled more than 2 days later, that is SD is equal to TD plus number of days greater than 2. In other words, the two parties agree the trade on a particular date and exchange the two currencies on any particular date after T plus 2. The settlement date is customized as per the requirement of the counterparty. An FX swap is a simultaneous exchange of same currency across two different settlement dates. A foreign exchange swap allows sums of certain currencies to be used to fund charges designated in another currency without acquiring foreign exchange risk. It permits companies that have funds in different currencies to manage them efficiently. It is not to be confused with currency swap. An FX swap is mix of anything. This can include cash plus forward, spot plus forward, cash plus term, spot plus term plus forward, or cash plus spot. Both the legs of swap have to be agreed at the same time. In other words, the trade date of two legs are the same. The main aim of an FX swap is to manage the funding of currencies across various business units to identify the excess versus shortfall in the bank accounts. The table shown on screen shows the famous nicknames of the various currency pairs around the world. For instance, Great Britain pound is to USD pair is known as cable, USD is to JPY is known as ninja, and so forth. The other forms or notional are also shown on screen. Billions are called as yards. Millions are also called as mil or M or bucks. So if a trader says he wants to buy 10 bucks, he means 10 million, and 1 yard he means 1 billion. Before we end this session, let us take a look at a couple of high-profile currency-related case studies. The Russian ruble saw an unprecedented decline in its value in the year 2014. This currency collapse was due to three main reasons. First is sanctions imposed on Russia. After annexation of Crimea by Russia, international countries imposed economic sanction on Russia entities, which impacted local banks that were funding their debt in rubles. Additionally, a lot of foreign investors started selling off their positions in Russian market. This is because they were concerned that any upcoming sanction could further block their ability to exit in a Russian market as and when they wanted. This resulted in increase in supply of ruble, depreciating it against dollars. Next, we have fall in price of oil. Roughly half of the Russia's revenue are generated from sale of oil. When the price of oil fell approximately from $100 to $50, this resulted in a massive blow to Russian economy, which was already reeling from sanctions imposed on it. Lastly, we have political conditions. The Russian government was also criticized for running a kleptocracy, which refers to a situation where a small group of politicians use the most of the resources of a country. This had a negative impact on the Russian ruble. Russia's central bank was forced to raise interest rates by whopping 650 basis points, but the hike was no avail and did not satisfy investors. Thus, the Russian ruble fell from 36.24 to 66.03 against the US dollar during this period. Next, let us briefly examine the currency drama surrounding the Swiss franc. The Swiss franc was considered to be safe investment currency as budget of country was fairly balanced. And hence it was used as an investment venue by most of the large institutions. Hence there is demand in CHF, which is appreciated the exchange rate against the other currency. To counteract the sudden increase in demand of CHF, the Swiss National Bank, also known as SNB, printed CHF and bought euros to stabilize the currency. An increase in supply of CHF depreciated its value. The reserves swelled to around $480 billion worth of foreign currencies, euros in particular. A huge reserve primarily focused on euro led to SNB to peg itself to euro exchange rate. This means that if the euro appreciates against global currencies, CHF would also appreciate and vice versa. This was implemented in year 2011. Now, due to the depreciation of euro due to recent euro debt and Greek crisis, the value of Swiss franc also saw a decline over a period of time. This resulted in Swiss franc being devalued against the global set of currencies only because of its peg to euro. On Jan 15, 2015, Swiss National Bank suddenly decided to unpeg the currency, resulting in a 20+% price change within a day, from around 1.2010 CHF per 1 euro to just less than 1 CHF per 1 euro. This showed the true value of Swiss franc against the global market. Now you have reached the end of this session. Thank you and goodbye.